Hey traders, welcome to Charts and Coffee, non-farm payroll aftermath edition. One of the things that I was thinking about after the end of quarter is that there are certain days that I typically choose for myself and warn other traders not to day trade. Swing trade, overnight trades, longer term time frames are fine, but not to day trade because of the amount of volatility, but not the amount of volatility alone. Because, frankly, I have a tool for that. I have a tool that looks at historical volatility, and I've got a way to manage that. But when we talk about non-farm and end of quarter and options expiration, a lot of times these specific events create volatility that expand beyond historical volatility. And when we expand beyond historical volatility, it's harder to manage risk because what we expect to happen, what we would think is going to happen, is in fact not what happens, and that makes it far more tricky and treacherous to manage risk. I mean, that's what we do. We manage risk, right? So I thought, wow, a lot of traders were trading end of quarter, and I didn't touch that thing with a 10-foot pole because trades and my studying them have taught me, Ron, that's not a high win rate day for you consistently. And honest traders look at their book of trades over the course of months, if not years, depending on how long you've been at this, and you'll realize certain patterns emerge. Certain times of day are going to be better for you. It could be pre-market. You could be an amazing pre-market trader, but the close is no good. Or maybe you're really great at trading in the morning, but pre-market isn't so good. So once you start seeing where your losses are coming from, not I lost, but what symbol, what time, it's going to start to clarify, when you're going to be better off trading and not trading, and more so developing a do not trade plan. So I hope that makes sense. And then for me, NFP is one of them. But I thought, let me show the traders why this is. And when you see why this is, it makes a lot of sense. So a lot of folks are asking, well, why this response? Again, this response makes perfect sense if you've been following the show for any length of time. And you might say, Rog, wait a minute. Good jobs data should send the markets lower? Well, if you've been watching Charts and Coffee, you know that good and bad are subjective terms. Good and bad to what is a more complete thought. What does that mean? Okay, Rog, don't get all philosophical on me. I'm not. This is really how the rubber meets the road. If you take a look, and let's do this together here. If we take a look at what the data ultimately was, let's scroll on down to Friday. Let's talk about quote unquote good and bad. The non-farm payroll came in at 263, so we created 263,000 jobs, which is more than the expectation of 248,000 jobs, but it's less than the previous. Little mix, but overall, the market calibrated, traders, investors calibrated to 248,000 new jobs. We got 263. That is quote unquote good. Okay. The employment rate lower by 0.2. That would be, again, these are headline numbers. These are surface level interpretations. That is also good. The employment rate is down. That means more people are working. We know more people are working because the non-farm employment change was also higher. The average hourly earnings remains flat. And considering that the Federal Reserve likes to see not just inflation back when they had that 2% target, which clearly we exceeded, but they also wanted to see wage inflation. Yeah, that's not great, but it's not earth-shattering. This is good data. Why would good data send the market lower? Well, if you've been following Charts and Coffee, you know that if buyers, bulls, are waiting for the Fed pivot, they're waiting for a reason for the Federal Reserve to basically wind down the tightening, peak for the target rate probabilities, and just get us back to a non-tightening cycle, this does not inch us closer to that. Disappointing news that the Federal Reserve is negatively affecting growth and jobs and inflation. Well, they want it negative inflation, but negative in terms of the good and bad. Anything that indicates they can and should keep going, buyers of stocks are going to hate that. If this number was a miss, it would inch us closer to the Federal Reserve saying, yeah, we're closer to being done than not. Let's take a look at December's target rate probability. We really haven't changed much. However, the column to the right, which is 4.5 to 4.75%, has spent most of the week very, very small. Now it's the second tallest column. Clearly nowhere near the highest probability, which is we'll be at the 4.25 to 4.5 target rate come the end of the year. But anytime columns to the right start to increase in size, and this is our biggest problem here. And JP Morgan talked about this about, 2 weeks ago, a 4.75 to 5% target rate probability. We go out to next year, this March, this notion that we're going to level off at 4.5 to 4.75, still the front runner in terms of expectation, but all of a sudden here comes 4.75 to 5%. Again, stocks are going to hate that. This is how we interpret every data point we get, but most especially inflation data, jobs data, and growth. That's it. That's it right there. So that's what's going to send equities lower. I hope that helps because it is a very formulaic and I think pretty common sense approach once you realize what that sense actually is. All right. So no, I do not recommend non-farm payroll trading from 9:30. My typical window with the Sector Secrets Mastery Prabish is I will day trade with our group from 9:30 to 10:35. And that's Monday through Friday. But on non-farm payroll, options expiration, and end of quarter, I will not day trade. But I thought today, every now and then, I'll look at an 8:30 hot zone like a GDP, initial claims, CPI, PCE, and NFP, knowing that I should trade smaller size, be a little bit more moderate to conservative. Every now and then, I will trade the 8:30 hot zone, but I really don't recommend it. And my life is no better, well, frankly, or worse for that. So my thought is, why expend the effort? And so Friday today becomes, hey, let's prepare for next week. Let's see how we close, how we trade into the close today. And we have our 90-minute session starting at 2:30 in the simpler futures. And of course, my Sector Secrets Mastery room. So no NFP trading for this girl. I'll show you all some things I might do. I'll do that in the mastery from time to time. And we did do that today. But I think my real agenda for that session was for folks to go, oh gosh, no, that's not worth getting up in the morning if you're on the West Coast. Oh, that's not worth risking my capital. And that's really what I was hoping the takeaway was, because this week I was tallying up the trades. We've been putting on anywhere from 4 to 6 day trades on each morning, usually by 10:35 Eastern. And when I looked back, I actually try not to get too wrapped up in a win rate or loss rate so it doesn't affect my week. I just try to treat each day trading day fresh eyes, open mind, no negative bias. And I was looking at this week's trades, barring this non-farm payroll trade, which I, again, do not recommend and would not recommend trading for anybody, really, unless it's something that you have found you're quite good at. Right now, we're sitting at a 77% win rate for our trades this week. So my thought is, and those were all trades from 9:30. I think we had a couple of trades that were past 10:35, but the bulk of those trades were made 9:30 to 10:35, 4 to 6 entries per day. Normally, 6 is pretty active for me, but 3 to 4 is pretty normal. And on average, that's about where we've been. That morning, hour and 5 minutes, 9:30 to 10:35, setting up trades has continued to be magical since mid-June. It's been very, very productive. Not worrying about whether or not non-farm payroll sends the markets higher or lower, not worrying about where we end up because of Powell and company, and just worrying about those 65 minutes. All right. So next up, hey there, Bernie. Is there any option strategy? I'm not very familiar with options. Okay, no problem, Bernie. We all start somewhere. To go long on both a call and put at the money just prior to a big economic report drop. I don't. Yeah, there's plenty of ways to bracket. And yes, there are two really basic strategies. that I've noticed. And this is broad strokes. You can get a lot more detailed, but basically, you can either go out of the money, or there's if you want to look them up, it's a very old school process. If you have a bias, you can look at a strip or strap option strategy. You can bracket with out of the money, or you can go with uh, kind of like you said, at the money, and then. But my problem with that is, um, I don't like to hedge. That's not my typical. I like to be directional. But yeah, there are a number of them. I just don't do them. Yeah, I just don't do them. But there are a number of them. Strip, strap are two. Those are old school um, strategies. And then it's and strips and straps are long call, long put. But you would go 2 to 1 depending on your bias. Then, like I said, straddles, strangles. Those are all very common. Yeah. All right, next up, editor. Would I trade the SPX at the open for a move down? Again, I do not trade non-farm payroll, gang. When I say I don't trade it, I'm not even going to have my charts on. I really don't trade it. However, hypothetically, I find a lot of, I don't know if it's just, oops, hang on. What happened here? What did just happen there? Oh, toss. Oh, thinkorswim. Hang on, gang. Let's get the trading view to the rescue here. So the question is, would I? There's a likelihood. I call it an echo. And what I mean by that, wow, this thing really crashed. Continue. There we go. Oh, look at that. I restarted. I started up trading view, and all of a sudden, toss started behaving a little bit. So what I call it is the echo effect. Editor, I call that the echo effect. We'll stick with toss here because the HPMRs look so good here. It's the echo effect. Remember, there's a group of traders that at 9:30 were not able to trade that hot zone. At 9:30, they have access to their market, which is stocks, ETFs, and stocks and ETF options. So yes, oftentimes I do anticipate that echo, usually within the first 15 to 20 minutes. So I would expect that. Now, if you're going to play any kind of fade, then I would look at the 5-minute high-low and wait for a momentum move, because I'm not going to presume that in this case, it's going to be a gap. We have a gap, not a true gap, but just a vanilla gap. I'm not going to presume any gap fades until I get the pattern. All right, next up, XLV. Mr. Walker, in terms of their structure, I don't have any skin in the game on either, and I probably don't plan on it, but I would say XLF. If you're favoring one over the other, I would favor XLF because it's in a downtrend. So we have the clarity of the trend working for us here, which is to say short the rip is a higher probability setup. Okay. Let's see. Why not wait for the first 15 minutes after the NFP to enter? So Eden, the question is, why not do that? So my answer is, you sure could. What I know usually happens at that point, and I'll show you what I was looking at here. And it's a perfect, so the 15-minute cutoff, just to kind of give everyone a little bit more depth on the understanding of why 15. The 15-minute cutoff is usually, it takes non-farm payroll, which is a huge batch of data. We just get these headline numbers. The overall data has a lot more to do with sectors, and there's a lot of minutia in that report. And it takes about 12 to 15 minutes for all of it to be flipped through and sort of that information then to be disseminated. Here's one thing you could do, all right? And it's something that I have looked at before, but it's not necessarily waiting for 15 minutes. It's waiting for volume. So let me show you all this here. And some of you might find this interesting. It's waiting for volume. So there's two things I will use. In terms of why I will enter with a high impact, high heat hot zone. One is going to be my HPMR zones, which have shifted far beyond what they looked like at 8:29 a.m. this morning. So this is not what they look like then. They're updating to the highs and lows. And the HPMRs are going to be actually the red zone's off. The green zone is exactly where it was. So the green zone buy is one thing you can do. But Eden, if you've got the V-score, now let's talk about volume. The last few sessions in the Sector Secrets Mastery, Eden, have been discussing that before we get a price shift, we almost always get a volume signal. What does that mean? Well, look at since 7 o'clock this morning. Support, support. There it is, support. Does this work? I will day trade between 9:30 and 4 o'clock, and I'll day trade between 7 and 9 with V-score quite often. Normally, the HPMRs, or historical volatility, does a really good job. But if you want to look at the next high heat hot zone, Eden, with my V-score, that's what it should look like. So if you're wondering, okay, Rag, where would that put me? Well, that is not at the low. It's not at the bottom. It's in this area right about here, right about there. Now, the volume bottoms out, and then the expectation is then price will too. So another thing I would say, Eden, because you're in my Sector Secrets Mastery, let volume bottom out and then look for a minor low. And I think you might like that as a potential setup. Okay, and that's for everybody, gang. That's for everybody. All right, next up is, bear with me, gang, we get these questions. Could I connect the dots? Hi, Dorothy. Could I connect the dots between buyers not liking? Oh, the data? So buyers are not going to like any reason for the Federal Reserve to continue to hike, which it looks like 4.75% to 5% is in play. And buyers or bulls of stocks, right, are not going to like that this data isn't blatantly telling the Federal Reserve you're killing the economy. That's what they're waiting for. Fed pivots have historically come off of data that suggests they've gone too far. And that's how we connect the dots. What do we think the data is going to tell the Federal Reserve about their current action? And then we respond to that. Thanks for the question. Hey there, Raghee. The new wave of excitement towards selling SPX 0-day expiration options seems to have an outsized risk profile. I think it depends on the trader, Raghee. I don't trade SPX options. I know they're the popular kid in class. Here's the thing. Whether you trade SPX options or SPY options or ES futures options, or maybe even ES futures or the micro, MES, the whole idea is taking advantage of the S&P movement. So the thing that's oftentimes lost on trading SPX specifically, it's still a reflection of the S&P. Now, what makes them different than all the rest is that unlike all the other types of options, SPY puts and calls, ES puts and calls, is that SPX is a European style option. You might say, what does that mean, Rog? I didn't know there was sort of American style options and US. Yeah, there is. If you buy a US kind of style option, I don't know how else to describe it. You can exercise that option anywhere between the moment you bought it and the moment it expires. SPX, the reason for all that craziness and that intense theta decay is because you can only exercise them on the day of expiration. And that makes all the difference in the behavior and the pricing. And that's why we get that higher volatility, because everybody has to exercise that option that day if they're going to. And you create this massive volatility. And therefore, their behavior, because of the way they must be exercised, if they're going to be exercised, is far different than other options. That's a European style option. So so what is out? So for those of you wondering, what does outsized risk reward mean? And I would love to dive into this one of these days and just sort of have a money management, risk management oriented conversation. If we have a 2-to-1 risk reward, and the actual number escapes me right now, but if you have a 2-to-1, and sorry, I'm looking away from the camera here, but if you have a 2-to-1, I thought I had this written down somewhere. I'm an English major. People think you need to be good at math to trade. I am absolute living proof that is not true, but I cannot find the doc. But if you have a risk of 2 to 1, just to break even, just to tread water, you have to have about a 67% win rate. If you change that to 3 to 1, again, you're risking 3 to make 1. Now it's 75%. Now flip that around and risk 1 to make 2, right? All you need is a 33, 34% win rate. Let's make that even more severe. How about risking 1 to make 1.5? All you need for that, a 40% win rate. In other words, I'm not saying win rate is everything, but why not put probabilities on your side where your risk reward ratio doesn't have to have you winning 6 times out of 10 just to break even, right? So that's why you'll find professional traders do not have upside down risk reward ratios. And to your point, it's not specific to the SPS, it's just trading in general. Okay, I hope that makes sense. All right, gang. Just like that, I'm out of time. Thank you, as always, for being here for Charts and Coffee. I'll see you all Sunday at the Simpler Trading YouTube channel for our weekly Sunday, 6 p.m. Eastern Raghee report. We take a look at the week to come. All right, gang, be good to each other. I will talk with you soon.